We're diving into the wild world of interest rates and what they mean for your hard-earned cash. Whether you're a seasoned investor or just starting to save, understanding interest rates is crucial. The Federal Reserve, also known as the Fed, is like the economy's conductor. They set the tempo for the entire financial system. They set the tone for interest rates, which directly impact everything from your savings account to the stock market. When the Fed makes a move, the ripple effects are felt far and wide. Right now, all eyes are on the Fed because they might just cut rates. This potential move has everyone from Wall Street to Main Street buzzing. This has huge implications for your wallet, and we're going to break it all down for you. From your savings to your loans, every financial decision you make could be influenced by these changes. So, what's the big deal with interest rates? Well, they're the price of money. Essentially, interest rates determine how much it costs to borrow money and how much you earn on your savings. When the Fed cuts rates, borrowing money becomes cheaper. This can be great news if you're looking to take out a loan for a new car, a home, or even to start a business. That means lower interest payments on your loans, which is always a good thing, right? But hold on. There's a flip side to this coin. It also means you'll earn less interest on your savings. So, while borrowing becomes cheaper, saving becomes less rewarding. It's all a balancing act. The Fed has to carefully manage these rates to keep the economy stable. The Fed wants to keep inflation in check, while also making sure the economy keeps humming along. They aim for a sweet spot where growth is steady and prices are stable. Now, the Fed doesn't make decisions in a vacuum. They're closely watching how the economy is performing. They analyze a myriad of data points, from employment rates to consumer spending. Lately, there's been some uncertainty, thanks in part to trade tensions and tariffs. These global issues can have a significant impact on economic stability. This has made the Fed a bit cautious. They need to tread carefully to avoid triggering a recession or overheating the economy. They don't want to make any sudden moves that could rock the boat. Stability is key, and sometimes that means taking a wait-and-see approach. But here's the thing. The market is already pricing in rate cuts. Investors are making moves based on their expectations of what the Fed will do next. Investors are betting that the Fed will lower rates to keep the economy growing. This anticipation can drive market behavior even before any official announcement. This is where things get really interesting. The Fed's decisions can send shockwaves through the stock market, bond market, and everything in between. The interconnectedness of these markets means that a change in interest rates can have far-reaching consequences. So, if you're looking to make smart financial moves, you need to understand what the Fed is thinking and how it might impact your investments. Knowledge is power, and staying informed can help you navigate these turbulent waters. Don't worry, we've got you covered. We're here to break down the complexities and make it all easier to understand. In the next few sections, we'll dig deeper into how rate cuts could affect your savings, loans, stocks, and bonds. Stay tuned, and let's get financially savvy together. Remember that trade war we were talking about? It's been making headlines for months now, and it's not just a fleeting issue. Yeah, well, it's not just about tariffs and trade deficits. The implications run much deeper than that. It's about uncertainty, and uncertainty is the enemy of a healthy economy. Businesses hate uncertainty. When companies are unsure about future policies, they tend to hold back on making big decisions. When they don't know what the rules of the game are, they become hesitant to invest and hire. This hesitation can ripple through the economy, affecting growth and stability. This can slow down economic growth, which is something the Fed wants to avoid at all costs. The Federal Reserve plays a crucial role in maintaining economic stability. On top of that, tariffs can push up prices for consumers. Higher costs for imported goods mean higher prices on store shelves. Think about it. If a company has to pay more for imported goods because of tariffs, they're likely to pass those costs on to you, the consumer. This can make everyday items more expensive. This can lead to inflation, which is a general rise in prices across the board. Inflation affects everyone from businesses to consumers. The Fed has a dual mandate: to keep inflation under control and to maximize employment. Balancing these two goals is a constant challenge. That's a tough job even in the best of times. The Fed must navigate complex economic landscapes to achieve its objectives. So how does this all tie back to interest rates? Interest rates are a powerful tool in the Fed's arsenal. Well, when the economy is facing headwinds like trade wars and inflation, the Fed might decide to cut interest rates to stimulate growth. Lower rates can encourage borrowing and investment. lower interest rates make it cheaper for businesses to borrow money and invest. This can lead to more job creation and economic activity. They also encourage consumers to spend more, which can boost the economy. When people feel confident about their financial situation, they are more likely to make purchases. See how it all connects? The economy is an intricate web of interdependent factors. But here's the catch. The Fed has to be careful not to cut rates too aggressively. Doing so could have unintended consequences. If they do, it could lead to runaway inflation. Hyperinflation can destabilize an economy and erode public trust. Remember, when prices rise too quickly, it erodes the value of your money. Your purchasing power diminishes, making it harder to afford basic necessities. The Fed is walking a tightrope, trying to find the perfect balance between supporting the economy and keeping inflation in check. It's a delicate act that requires precision and foresight. It's a delicate dance, and the whole world is watching. Every move the Fed makes is scrutinized by global markets and can have far-reaching impacts. Okay, let's talk about your money. Specifically, the money you've stashed away in your trusty savings account. You know, the one you thought was a safe bet. Now, I know what you're thinking. Savings accounts? Those things barely earn any interest as it is. It's frustrating to see your hard-earned money just sitting there, not growing. And you're right. But here's the kicker. If the Fed cuts rates, those already low interest rates on savings accounts could go even lower. Ouch! This means your money could be working even less for you. I know, it's not exactly what you want to hear. It's disheartening, especially when you're trying to be financially responsible. But don't despair just yet. There are still ways to earn a decent return on your savings, even in a low interest rate environment. You just need to be a bit more strategic. First things first, shop around for a better rate. Don't just settle for the first option that comes your way. Don't settle for the measly interest rate your current bank is offering. There are better options out there if you're willing to look. There are plenty of online banks and credit unions out there that are willing to pay higher rates to attract your business. These institutions often have lower overhead costs and can pass those savings on to you. Another option is to consider a certificate of deposit or CD. CDs can offer significantly higher interest rates compared to regular savings accounts. CDs typically offer higher interest rates than traditional savings accounts, but there's a catch. You have to lock your money away for a set period, usually ranging from a few months to a few years. This means you won't have immediate access to your funds. If you don't need to access your money right away, a CD could be a good way to earn a little extra interest. It's a trade-off between liquidity and earning potential. The bottom line is this: don't let low interest rates discourage you from saving. It's still crucial to have a financial cushion. It's still important to have a healthy emergency fund and to save for your long-term goals. These goals could include anything from buying a house to funding your retirement. Just be smart about where you park your cash. The right strategy can make a big difference in your financial health. Do your research, explore your options, and find a saving strategy that works for you. With a little effort, you can make your money work harder for you, even in a challenging financial landscape. Now, let's flip the script and talk about borrowing. If you're thinking about buying a house, a car, or even just putting some expenses on a credit card, listen up. When the Fed cuts interest rates, it usually means lower borrowing costs for consumers. That's because the interest rates on mortgages, auto loans, and credit cards are often tied to the Fed's benchmark rate. Imagine this. You're in the market for a new home. You found the perfect place, but the mortgage payments seem a bit steep. Suddenly, the Fed announces a rate cut. This could translate into a lower interest rate on your mortgage, which means lower monthly payments. Music to your ears, right? Of course, it's not always that simple. Lenders consider a variety of factors when setting interest rates, including your credit score, income, and the overall economic climate. But generally speaking, a rate cut by the Fed tends to create a more favorable environment for borrowers. So if you're thinking about taking out a loan, it might be a good idea to keep an eye on the Fed's moves. If they do decide to cut rates, it could be a great opportunity to lock in a lower interest rate and save money over the life of your loan. Just remember to borrow responsibly and make sure you can comfortably afford the monthly payments.